let's start with your questions, man, and I'll try to draw if I need something.
Yeah. So in terms of just to just start of a couple of is from your perspective, like what's the difference between an ICO, just from the top, like what's the difference between ICO and an airdrop and an air grab, like in terms of differences mainly, and
Well,
why do people use which one for which?
well, there are kind of like there are different kind of purposes because like between those mechanisms. So ICO was like I think first popularized by Ethereum itself.
Mm-hmm.
So you know what Vitalik accept Bitcoins and for I think by Ethereum because Vitalik got Bitcoins and allocate amount of Ether. So Ethereum is a blockchain, Ether is a coin. And until this time, like as we speak of May 2021, majority of Ether in the circulation happens to be people who bought it in a pre-sale. I think it's more than 60%. I don't remember statistics exactly. It's 60 or 70% of all Ether in existence, which right now on the blockchain, it's from people who bought it in ICO. So
Mm-hmm.
I think it's very cool mechanism of kind of fundraising because it didn't back then until it wasn't regulated. It was like super easy way to bootstrap like kind of crowdsource kind of investment attraction, and you just like share your idea like as Vitalik did, share your proof of concept or anything you feel worth to share and say, hey, send us some coins and we will do allocation like of future coins for you. So when we would have a coin, you will have it in the first and able to speculate and stuff like that. So it's like an IPO, but before you build anything. So, and it's obviously get like popularized in 2017 while we have this whole boom of ICOs, and you could make a lot of profit on because like just was a bull market and a lot of people invest in pretty much anything. And it was research where you invest in like 100 random ICOs and you still get like 10x if you do it like in October 2017. The problem with this, well, it didn't last because first of all, you have to get some kind of incentive to build something, but you already got money. So what is your incentive? So
Mm-hmm.
it's a problem of
Right.
ISO because from incentive perspective, it's a similar problem what governments do. Because when you work in government, you don't really have incentive usually to perform on your top of your abilities. You have incentive to stay in your chair and your incentive is actually do not fucked up instead of deliver as fast as possible. And the incentive structure, when you already have something and you do not want to lose, is drastically different from a startup environment culture when you want to deliver as fast as possible, break things, because you have to like grow faster than your competitors. So this problem of ICO are part of due diligence because like if everyone allowed to participate, everyone allowed to publish it, obviously the scam actors will start like receiving a lot of attention. So they have a big landing pages, a lot of promises, because like if you build a legit tech, you usually have employ like very hardcore developers who are not good at marketing. And people who spend all this effort into hire like a blah blah people like got a lot of attention and a lot of this scam project appears. So it's destroy legitimacy of ICO mechanism in my opinion. So in 2018, ICO was more like a joke, but not all of those ICOs in 2017 end up with disaster. For example, like largest DeFi protocols, among the largest DeFi protocols right now in 2021 is ex-ICO company like Aave. Aave used to be a land and they got a lot of money in ICO. So very legitimate project with like a lot of cool features. I'm not aware about other like super cool examples because I didn't research this, but for sure we're
Mm-hmm.
like big chart, big part of a modern like a DeFi ecosystem, like a Link token, for example, is companies who got during ICO era, but it's like more exception. Majority of them just like scam people and disappeared. So what you can do next if you would like to attract investment, but you know what ICO compromised itself, so you wouldn't want even to say ICO word. Well, you just rename it for something like IDO or IO, like initial equity offering or initial DEX offering, initial blah 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 offering, reverse IPO. So it was a lot of movement to kind of to rename this mechanism in order to kind of move away from just an ICO term, but to
Mm-hmm.
stay in ICO mechanism in principle. I think There are some successful cases of such attempts, but I'm not aware whether it exists now or not, because there are like landscape changed. So when DeFi came in play in, I think in 2018 was like first attempts to build something useful. And I was in a presentation of IDEX. IDEX, it was a DEX, like you can exchange one coin for another in decentralized way, and it was super cool presentation, but all was DeFi companies were venture backed in San Francisco at least. And when people start realizing yeah, it's actually cool, it's convenient, you don't have a KYC, you have a properties which you might not have in a real financial, not real like classical financial tools, like DeFi market like start getting up. And like from 2020, I think from the lowest point of a crypto price, like during COVID, I think it was March or April 2020, when Bitcoin used to be about $5,000 and Ether was like 100 something, like DeFi just skyrocketed to the moon. And until this date, so like 12 months after, it's got like 100x. So all DeFi projects appeared there and deliver anything useful got like extreme like attention. I mean, even like project I work as a hired CTO for Sigma stablecoin DEX. I mean, in a 10 weeks, we got more than $1 billion trading volume. I mean, it's insane if you think about that. And like our project, no way like the best or the biggest, etc., etc. I mean, definitely have a niche, but it's not something like well, cool people do, right? So there are a lot of like stream of newcomers to the DeFi. The problem comes like when you have limitation of Ethereum, because Ethereum like can scale, well, cannot basically have some limitation of how much information per block you can store. And it's a problem. It's a problem. So right now, as the time we're speaking, the gas price is a 63 gigawatt for fast transaction. It's probably translate about $7 ERC20 token transfer and about maybe $30-40 per typical harvest transaction. This is create certain lower threshold, like how little capital can you have in order to use DeFi solutions on Ethereum. Because like if you have a less than $10,000, in my opinion, you have nothing to do with DeFi on Ethereum right now, because just these commissions for a gas would just eaten all your possible profits. Unless you're really lucky and you get some kind of like a Dogecoin, which like will make 10x or 100x, which I never did. So I play safe and like some kind of with measurable risks. And at least in my situation, I think that with less than $2,000, there is nothing to do in Ethereum right now. But there is demand for people who have less than $10,000. Look what you can offer them. And here's big exchanges come to play. For example, Coinbase and Binance, like Binance Launch and Coinbase Acquire, with partnership and stuff, two Ethereum testnets. Well, they don't call it testnets, they call it different blockchains, but basically a fork of Ethereum with just larger blocks. And one of them called Binance Smart Chain and another one called Matic Polygon. And those solutions are nothing else than just a copy of Ethereum code base with just changing parameters, how consensus works and what is block size. It worked for a while, very good, because like when you can do a lot of transactions, obviously, like, yeah. The problem with transactions, very complex topic though. So the problem with transaction that you have a demand and supply, and if demand a little bit increased, your price just skyrocket 3x. It's unnecessary to have a 3x demand increase when price will 3x. It doesn't work like that. So when you have a supply demand on a level, you have a certain like a level price. It might be like 1 gigawatt, maybe a 10 gigawatt, maybe a 50 gigawatt, doesn't matter. But as soon as like this kind of very fragile equilibrium change, the price of a gas change rapidly in a very big range. It's super volatile. And if you increase block size, price very rapidly drop to zero. And that's why transactions in a Binance and a Polygon cost like almost nothing. But it comes to the cost, because like in a Binance Smart Chain, since block is large, you have to have a very powerful computer in order to run a full node, like super powerful. Like the state is like several terabytes. And like even if you buy like something like a top machine in a digital ocean, you will have a problem with the synchronization, of Binance Smart Node, Binance Smart Chain. It's a disaster essentially. Like you have a couple of hardware like all owners who are able to run this node, and it's centralization. But there is no question about whether it's decentralized or not with Binance. Binance is like super centralized. And like I personally got scammed on the Binance exchange. I put 2 Ether in 2017 and I wasn't able to get it back. So Binance scammed me. Like I'm Alex Libet, this video gonna be in YouTube. So I like publicly say Binance scammed me and I can prove it in a court. The only reason I didn't go to a court just because it's not a lot of money. It wouldn't justify the expenses for lawyers. But as soon as like if I go up or like I would be suddenly like more wealthy, I will totally go to court because like I lost my Ether because it was scammers from Binance. But nevertheless, a lot of people didn't get scammed and they use it because it's cheap and they use it because it's convenient for them. And Binance Smart Chain got a lot of attention. So you get a shitload of users, you got a lot of capitals right there, but the whole infrastructure a little bit like cranky around because it's like it just doesn't properly implement it. Like just Ethereum with bigger block. Ethereum wasn't designed to have that large block, and it creates like only a few machines able to run it. Even those machines who run it with problems, where a synchronization problem, and you're unable, for example, to have a statistic about this blockchain because like you have to get a special Z-graph thing. And because you cannot synchronize the node, you're unable to fetch the proper data blockchain. So essentially like a black box in a sense. You don't know what's going on with blockchain because you're unable to fetch data because like from where you usually fetch data, unable to synchronize the full state. So it's a problem. Polygon on our end from a Coinbase claim what they decentralized. I didn't go deep in math and like how consensus works, but I know the team of Masic. And back then, when I met them in New York in 2019 in the EVE Global Hackathon, the project was just a testnet of Ethereum. So it wasn't technically impressive at all, but they got a lot of attention. So I don't know, maybe it's story like Chainlink, because Chainlink was like absolutely scam. They just claim a lot of partnership with Google, with Oracle, which wasn't true. And they actually, people tell, yeah, after that, they saw they didn't have any partnership with you. But they got this attention, they got this momentum, and they got enough capital to actually implement eventually something worthy. And right now, Chainlink is indeed very worthy DeFi building block. Oracle is a very hard problem to solve and super capital intensive. You have to get a lot of money to run it. And Chainlink, just because they properly mark themselves, able to get that amount of capital, able to attract like the good developers and build something. Maybe with Matic, there is a similar situation. But yeah, coming back to your original question, like is ICO, IDO, and different like initial something offering, or a whole range, whole spectrum of a provable mechanism already, not provable, proved mechanics, how you can attract capital. And some of them involved like just direct communication with B2C, like essentially like with users directly, but because likely there might be some legal consequences of doing that, it's preferably to do anonymously, because like it would be likely sometime in the future, or maybe right now, but these would be deemed illegal, and you cannot sell security without proper licensing and stuff like that. So it's very, very problematic to do it like in ICO style of 2017 as today. But there are different kind of way arounds. An initial DEX offering is one of them. So you basically create a token. You kind of able to kind of justify what is utility token with a legal team because it has utility properties and like there is some kind of like test whether it's security or not and stuff like that. And what you do, you offer some farming. So what farming is? Are you familiar with farming terminology, how it works?
Is it basically kind of pseudo mining on an Ethereum contract to some extent, or I don't believe him.
Well, yeah. So basically how it works in a nutshell, you have a token, utility token, and you would like to create a liquidity for it. So you would like to create some sort of a trading volume between your newly created token, like let's say token X, and let's say Ether, right? How are you able to attract this liquidity? Well, you can just ask your friends to just put liquidity and create a Uniswap pair. Uniswap is like largest DEX, largest exchange on Ethereum. So it's a largest decentralized exchange on Ethereum platform. It has like billions of dollars of liquidity. And how it works, very interesting. So I wouldn't go like very deep in math. In actual, you can think as a continuous order book. using some mathematical formula. So it's technically called automatic market maker. So what it means that you deposit equal amount of $1 worth of Ether in your own token. And this liquidity stays in contract, and anyone can come and exchange one for an hour. And the only invariant which have to be true before and after exchange, what multiplication of amount of your token multiplied by amount of Ether should be equal before and after exchange. So if you see all these pairs of a solution of this, it would be a hyperbola. And you can think as a continuous order book, which is always there, always able to work for you. And how you are going to attract liquidity for it? Well, one of them, you just give them commission on exchange. So every exchange would have a 0.3% commission. So if you exchange like 100 token X for Ether, a person who exchanged it would pay 0.3 token X in commission. And this commission would be spent on liquidity providers proportional to how much capital they provide. This is nice, this is good, but this is not as much as you could get. So what SushiSwap, it was Uniswap who did this system. And some guys were copying, basically they forked Uniswap and call it SushiSwap. And what they different, they say, okay, guys, we're going to give you 0.3% on an exchange. But above that, they would also give you our token as additional benefit. The only thing you should do, you just like deposit liquidity. And when you deposit liquidity, you get sort of a call liquidity pool token. It's like LP for short. Imagine this is kind of like a share of ownership of this liquidity pool. And when you get the share, you put it in a special contract, and the special contract accumulates you dividends, not dividends, but like rewards every block. And you basically give a share. Imagine like if you provide liquidity and of a company whom you provide liquidity give you share of a company every second. It would be way more attractive kind of deal for you, because APR, like annual percent return on investment, whatever you call it, would be higher, because like stock cost something more than zero. But why it worth more than zero? Well, because you spread some dividends for this kind of stock, or you do different mechanics. And one of these mechanics, you say, okay, guys, please deposit liquidity in our token X in Ether, and we will get you token X as a benefit of that. So it's a little bit Ponzi. Well, it's not a little bit Ponzi. It's actually completely Ponzi from this point of view. But it's a mechanism which able to bootstrap your protocol, kind of like Ponzi-like schema. And if you do legitimate business, you're really able to sustain the demand for a token, whether you pay interest for it, or whether you have a good marketing, or whether you have something else. So if you're able to sustain this kind of like a bootstrap framework, how you could get your token from no existence on the mainnet to some sort of a trading volume and liquidity volume on the chain. And this got super successful for SushiSwap. They able to steal about $1 billion liquidity. It's like was 50% of liquidity from Uniswap. And everyone saw, wow, that's cool, let's do that. And basically everyone started doing that. It's a working framework to launch and get initial liquidity for your DeFi protocol. The only what separates legitimate usage of this framework from not legitimate usage is like what you exactly do. So is ICO. ICO mechanism by itself doesn't have any kind of problems. Mechanism itself is legit. What is not legit is how people use it. Same with DeFi farming and stuff like that. So very a lot of scam, a lot of rug pulls and stuff like that. But bigger chunk, or at least project I'm aware, actually very legit. And problems what they solve is really something important for me, and solution what they do really sound like it might work. And that's why I put my liquidity in different DeFi projects to get those tokens like as shares or to buy them. So it's a new way to attract not investment, but a liquidity. The difference when you do investment, you essentially kind of like you get investors' money. Investors do not have money anymore, but you give them token instead. When you do this stuff for liquidity, you do not just take this liquidity, you borrow this capital. And like your lenders, people who borrow you this capital, able to get it back whenever they want. So it's like a
Mm-hmm.
little bit different. One of them an investment mechanism, and another
Okay.
is a lending mechanism. But there are
Mm-hmm.
very, very thin difference between them, because if you have a Uniswap pair of your X token and your Ether, and let's say X token goes down, like the pool would create a lot of X, will have a lot of X tokens, but very little Ether. So when you get back your liquidity would have like, if you put $1,000 Ether and $1,000 X token, and X token get down like 3 times. When you get your liquidity back, even though that would be same percentage, the dollar volume, a dollar value would be lower. It's called impermanent loss. Impermanent loss, it's not even impermanent loss, it's part of your share. So impermanent loss is very popular term, but very often misused. Even I misuse it here in our conversation. But you can Google it further. Basically, like when you give, there are two types of lending your capital. One of them, when your capital do not have any risks in terms of like if tokens go down, stuff like that, like a stable coin pools, for example. When you lend in a Curve or a Sigma where I work, stable coins are stable, so the dollar, like regardless of the price of Ether, and I put like $100,000 there, I receive some shares, I sold those shares, I get my 100,000 back, didn't lose anything. But when you have this pool 2, so-called pool 2 or liquidity pool, when you have a token X and Ether, token X will be very volatile. And if token X would just go down, you would lose your capital. So you have to be very careful where you provide the liquidity. And there are some websites who help you to navigate across all this DeFi space. And some of them mention like what kind of risk does it have? It has no risk at all because it's stable coins. It has some middle risk, medium risk because it's like, let's say, volatile currency itself, like Ether, or a super risk when you have a liquidity pool of governance token and Ether, because since you print this governance token to put as rewards for hour, like you increase supply, but with constant demand, increased supply would like put down the price. So it's kind of like better investment. Invest in a token which are not finite supply or printed a lot because of its used to not used to used by paying interest for our pools. So this is how it works in a nutshell. Did I answer your question?
Yeah. So in terms of in terms of there's different mechanisms of raising liquidity. And one of the most popular ones is using these swap protocols of liquidity pools that sound like very much like kind of basically kind of like bonds in a way.
Not exactly like bonds. When you like basically bonds as a mechanism is like a token for repurchasable agreement. So you purchase something and you have a promise what with something you purchase would be purchased back. So here is a little bit different. Nobody gives you, you don't purchase anything. You just go put your liquidity in smart contract and you're able to pull it back unless someone hack this contract or this liquidity. Well, you have, that's it. One condition. If this was hacked, you're able to put your liquidity back, but this liquidity might be in different conditions because a lot of tokens get printed and you get a little bit Ether and a lot of token X, which is like worth way less when it, yeah. So
I see. Okay. I guess moving, so in terms of airdrops and air grabs, those are just mechanisms of reducing, transaction costs. Right?
No, really. Like, depends what kind of airdrop you have. So, as I mentioned, Ethereum right now is notoriously expensive. So, like, each transaction, ERC20 transaction might cost like $40 when gas is expensive, or like $7 when gas is okay expensive. And imagine if you send like 100,000 people, so you have to get like almost $1 million just for gas. It's very expensive. So, what Uniswap did when they saw how much attention SushiSwap got by just distributing the tokens, and Uniswap didn't have token back then. They decided, okay, fuck you. They're also gonna have our token, and they call it Unitoken. They redistributed retrospectively for people who provide the liquidity for Uniswap. And how they did it using a Merkle rule proof. So it's essentially like they put list of addresses in the database, got a hash of this database, and built a Merkle tree on top of this. It's like a hash tree, and commit the top hash to the blockchain. And if you know your address and you know the path inside of Merkle tree, you just like put call transaction inside of this smart contract, and you say, here's proof what I'm in this database, please give me tokens. And it's how they distribute. It's like I don't know whether it's like a pool airdrop or whatever you call it. I never hear this word before, but it's more like a lazy airdrop or like a Merkle tree airdrop. So it's just to save gas. But there were also normal airdrops, like a brute force airdrops, when you literally in a for loop just send a lot of ERC20 transactions. Like Honey Badger did it. I'm not deeply familiar with Honey Badger case, and I didn't get airdrop for them, but I read what they did it very successfully. There are also second opinion what this airdrop was partially to put distribution of token to their friends. So it's not a real kind of like legitimate airdrop. It's like a distribute to their friends and legitimize this distribution. But I cannot speculate on that because I do not have a like a definitive knowledge to claim such a thing. But they did it on a normal airdrop. And Tornado Cash, for example, redistribute like a normal airdrop to the token holders. 1 inch redistribute using Merkle tree airdrop. So there are different mechanics how you can do it. But ultimately, airdrop might be used as a marketing tool where you do not give money just for fun, because well, why should you give money just for fun? You give money in order to achieve something. So you have to be certain call to action. So if it's like a kick ICO airdrop, when the airdrop token and this token wasn't transferable, everyone saw this kick ICO shit in the Ethereum scan. And they say, okay, I have like, I don't know, $100 worth of a kick ICO token, but with ICO token, I cannot withdraw. So it was like just a marketing campaign. So they didn't spend money. They spend money only to deliver this ERC20 token, but because you cannot claim it, they call it frozen drop. It was kind of efficient, I guess, for them. And there are different ways how you could do airdrops. You can do airdrop on Binance Smart Chain for users on the Ethereum chain because addresses are the same, right? It's just a fork. And Ellipsis is a Curve fork, like I think licensed Curve fork on a Binance Smart Chain did that. So they just copy Curve. It's a stablecoin DEX on Ethereum, very large. They have like $8 billion or something like that. And copy of them in a Binance Smart Chain did a lot of these airdrops. So basically, if you provide liquidity in Ethereum chain, they airdrop you a certain governance token of the Ellipsis DEX into Binance Smart Chain. So you can do it cross-chain as well.
Okay. So moving on to in terms of a question of like, how do you get started? Like, assuming you have an idea of a utility token, where do you go to, what do you, like, what's the general process that you would imagine the average like project goes through in order to like, do they use a specific platform today? Do they use Uniswap to, like, what are the usual requirements to start working on, like, from building to deployment to raising?
Well, there are no any kind of requirements, as you might imagine, because the space is decentralized. However, I'm familiar with cases like recent cases of different projects I work with, or I work inside, or I just seen. And usual process, you deploy your token on a mainnet, you put initial liquidity in some kind of Uniswap DEX, and you create some sort of a reward smart contract. Usually it's a fork of a SushiSwap contract. And you market it like using different strategies. So I guess marketing is not my strong point. And I can only say that, well, probably if you use the same thing as everyone use, it would be very competitive. So wherever you use something what people didn't use, it's how you do cheap marketing, right? And when you market somehow, so people know about your project, people are ready to farm your project, you just say, okay, guys, so in this particular time, like let's say tomorrow at 12 p.m., we will start and unlock this smart contract to farm, and people will like using your interface and deposit liquidity in order to earn your tokens. And what they usually do, they as soon as they claim your token, they just sold it and dump it on the market. So you have to be very conscious about your economy of a token. And what was the problem with the Sigma actually? People who like I'm just hire engineer, and this taxonomy wasn't like something new. It was just copy of a Curve taxonomy, but it worked for a Curve. but it doesn't work yet for X Sigma as well as we expected. So and for stable unit right now, I'm designing like totally different token economy where like hopefully kind of to move away from this like token drop completely. And it's a problem. I don't know any reliable source how to do it. And I spoke with a lot of smart mathematicians and economists, and there is no like any decisive conclusion or any consensus how you can do ideal economy. So every project will have a different economy. But I imagine like even if you call it utility token, like people who would buy it would expect what is a rise in price, which is like contradictory. So this utility token is more like to legally justify to avoid regulations rather than it's like really utility token for majority of people. It's not claim about project I work for. So it's just a kind of like side conversation. But the process like this, yeah. So you build something what you can use in order to provide liquidity, in order to remove liquidity, in order to use your own project, because what is the main purpose of your project, right? And market it for your target audience. There are some newspapers who specialize on it. There are some Telegram groups, Telegram channels, emails, like broadcasts, even TV channels, I think. And there are users who look after those projects in these channels of information. So you pay them to get somewhere like mentioned and how you get your audience. This is my understanding. There are maybe some guerrilla thing like, you know, guerrilla marketing when you do something what our people didn't do. I don't know, you maybe will run naked in St. Petersburg with QR code in your ass, right?
No, I'm good. Yeah.
Well, just something that our people didn't do. So, well, Richard Branson like wrote a fucking tank in a Times Square, right? In order to launch his Virgin Pepsi Cola thing, like sugar water. It didn't work for him, but at least he got a lot of cheap advertisement. So it doesn't. It's not really a DeFi thing to kind of get inside how you market thing, but with order drops, like guerrilla marketing, like key opinion leaders and stuff like that, will give you attention of users. So when you have attention of users, so you give them tool to provide you liquidity, to provide you something what you desire for your project.
And in terms of like, what's the general requirements? So when you say liquidity to initialize on Sushi Swap, are you saying that in terms of like Ether is like you basically setting an initial price point
Not only
Ether or in the token, or
there are two parameters. One of them you put initial price, but initial price would like break in a second. It doesn't really matter what you think initial price is. Second one is how much liquidity do you put. So for example, you put in a Uniswap $1,000 worth of Ether and you put 1,000 token X. So the token X worth $1, right? And you start farming, kind of farming. If you put a pool token in a smart contract, it will give you 1 X token per block. So it would be 4 per minute or 240 per hour. So imagine if you put like $1 in this pool, you get $240 like in 1 hour. This is huge APR, right? So there would be strong demand of people who just buy this token and put in contract and farm and sell it and move out. So those farmers are professional farmers. So you might get a lot of capital initially, but this capital is very kind of not persistent. So this capital is moving from one project to another project to another project to another project. You might get mistaken for like very large success by having, oh, I have $100 million in my smart contract. Well, you might have it today, but tomorrow they will just move out for another project and go forward. So very important to have a strategy how you attract in the long term, like these liquidity providers, and how you prevent the dump of token. Because if they would farm a lot of token, they would dump immediately in a exchange. Price would go down. Price would go down. API would go down. API would go down. Capital would move out. Capital would move out. There would be less liquidity. So dump even would further jeopardize the price of your token. So you have to probably, like what I did for stable unit, I just like took very close look at 10 projects and see like how they farm it, what the government structure is, and what they token distribution among the team, investor, and stuff like that. And just made some interviews with those guys except Uniswap, I don't know them personally. And it's helped me to kind of like figure out a basic picture of what is on the market, what works, and what might work for us. But I'm not in a position to give you some advices because, well, nobody knows. At least I do not know what would be ideal thing. But two parameters, how much liquidity and what is initial price. But initial price would like probably after 10 minutes would be irrelevant already. It's only how you handle it. For example, if you feel what price would skyrocket, you just start selling or you just start donating to the pool. Only be careful if you just send ERC20 token directly to the pool, you should call function sync. I will put you link in the article which I wrote.
Okay. Yeah. Yeah. Thank you very much. It would be great to have any terms of resources like that you use as a reference, as example cases. I guess. I mean, really, everything about this seems very experimental. So it's understanding case examples and how other people did it and how did they progress long term into their projects. So, yeah, that's very helpful, Alex. Thank you very much.
Yeah, you're welcome. If you have any more questions, let's just speak off camera.
Yeah, thank you.